Well, good morning, everyone. Welcome to Trading a Smaller Account. And holy smokes, Batman, do we have a jam-packed class for you today. As you know, the fabulous Connie Hill filled in for me on Friday. I was in Houston. I finally got to meet the fabulous Will W. and a host of other people. So it was really a great event. So thank you to all of you who came and who took the time to come up and introduce yourself. I'm going to post some of the selfies and stuff that we took later this afternoon. So, but what are we going to do today? Well, I just checked, and while I was gone, not sleeping, gone in Houston, we had 6 trades hit target. So we're going to have a quick look at those. We've got a little bit of additional trade management to do, a review on our 2 buy right positions, a quick review on our stock position with a target. We placed 3 trades on Albemarle, 2 hit targets. We have 1 to go. So we're going to have a little peek at that. We're going to look at a short call vertical position. And then we're going to place 3 new trades, and we're going to do a bullish trade, a bearish trade, and a neutral trade. So I hope you guys are buckled up. And if you are joining us for the first time, just know that the power in reviewing trades is, it's important for us to understand trade management, and getting into a trade is only half the battle. Understanding what we do once we're in is the other half, and it is just as critical. So that's why we spend some time in every class reviewing the trades we've placed. They just don't go into some like dark abyss where we wonder what happened. Natasha is asking if I would visit in Canada. I was in my hometown, North Bay, Ontario, about 250 miles north of Toronto for a week in October, and I go back as often as I can. So yeah, but it would be great if we could do one of these events in Canada, but we won't. So you're going to have to come and visit us here in the US of A, but depending on where you are, we're all across the country. So you can come and visit us in New York or Chicago if you want something close to the border. If you want to go, somewhere you might want to go anyway, like, Anaheim or San Francisco or Seattle, you can look at the schedule. We're all kinds of places. So we have got Kevin Horner with us in the chat today. He's a friend and a fellow coach. He does a really fantastic event every day at the Market Open, 4 days out of 5. So if you want a really great market overview, that's where you want to look. Okay. And you also want to make sure you follow both Kevin and I in the land of X. So at Barb Armstrong CS and at Kevin Horner CS. Yeah, and if you're going to be in Miami, I fly out Wednesday because it's a long way to go from Salt Lake City. Please come up and introduce yourself. I can't wait to meet you. So know that options carry a high level of risk. We have a lot of option trades and stock trades we're going to be reviewing today. But know that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn, hone your skills, make sure you understand your trading strategy and your trading plan before you consider trading in a live account. One of the nuances or differences is that short positions will never be assigned early in Paper Money, but that certainly can happen in a live account. Okay, so we're going to do a very quick market overview because Kevin just did a superlative review at 9:30 Eastern at the Market Open. So you can go back and catch that in the archives. We're going to place some new example trades, and then I've already gone over like the very aggressive list that I'm hoping to cover by the end of our 45 minutes together. So here is our, kind of speed version of a market overview. The S&P 500 up 15.5% year to date. Been in a little bit of a period of consolidation, but still, it's currently trading well above the 100, above the 30, flirting with the 10-day moving average, and not all that far from all-time highs. Okay, so that's what's cooking with the S&P 500, with the NASDAQ. And this, some might look at this and say, well, update your chart, Barb. Okie dokie. We've got a little bit of consolidation happening here, right? And the same kind of thing happened on the S&P. But again, this index up 18% year to date. And some might argue, a bit of a pennant type pattern. perhaps setting up, and we'll just see where that goes. Okay, and this one, not flirting with the 10, flirting with the 30. When we look at our small caps, you know, we hit a new all-time high on Friday, an intraday high. So, you know, that's pretty amazing. You know, so, and this index up 13.5%. So kind of in the same neighborhood with the other two. In the Dow, you know, it too hit a new intraday high on Friday. So hard to characterize that as anything other than bullish on all of them, right? And how's our VIX looking? Well, VIX up a little bit today, which, you know, given that all these indexes are pulling back a little bit today, is about what we expect, but it's in the lower end of the range of where it's been trading. And this is a 6-month chart. But, you know, if we look at a year-to-date chart, you know, it's kind of at the bottom of the range, right? So it's showing a relatively high degree of confidence in the market. Okay, so let's go and look at our first example trade for today. So this is GE Vernova. It's up over 100% year to date. So you might say, like, hello, like, haven't we already kind of missed this opportunity? It hit a new high here last week and setting up a bit of a bull flag pattern. But when we come in and look at this, what we've got, you know, some might say this is a bit of a doji or a candle of indecision, but it's also a harami pattern in that the body of today's candle totally inside the candle of Friday. And what that tells us, even though this is a live candle and it might change by the end of the day, is that this is a bullish pattern at a support level that does not require confirmation. And so if we said, well, if we're bullish on this from a technical perspective, because we had this kind of period of consolidation and then it gapped to the upside, you know, we might come over here and say, well, like, what are the analysts thinking about this? Well, HSBC just raised their price target from 590 to 650. JP Morgan just raised their price target to 1,000. So it would seem that, you know, some of these analysts seem to be somewhat bullish on this stock. You know, and you can go and click and read some of these articles if you want. But if we're looking at this from a technical perspective, you know, this might look strong. And we might say, well, what if we came down here to this, you know, 655, 660 level or 650 level? Could we do a short put vertical? So that's kind of sort of bullish. So if we come to our trade tab and we come out to this 650, you know, we've got hundreds of contracts. It's traded over 1 million shares a day. And that's part of our trading plan, our example trading plan. Like, does it trade 1 million shares a day or more? Do we have 20 times the number of contracts we're thinking of trading? And you know, these are $10 wide. So if we look at the 650, we get 340. What does that mean? How much are we risking? Well, we're risking 660. In this class, we don't want to risk more than 500, 550 kind of top. So we're going, eh. So then if we look at this and we say, well, would we be okay to do the 660? So if we look at 660, say, well, yeah, that doesn't look too bad. So let's come out and say, well, what if we did the 660? Well, we're still only getting 360, so we're risking 640. And that just breaks our rules. And is that a rule that we break? No, it is not. So even though this chart may look appealing, a short put vertical isn't a viable strategy this time in this account because we have to risk too much and we have these $10 wide spreads. So you might say, well, do you have $5 wide spreads? I like the way you're thinking. So we could come out here and go to 25 days. We have a little less liquidity though, you know, and our bid ask spread, like, so we've got a, let's see. So if we come to January 9th, that's 25 days, and we look at this 660, 15.5, 15.50 to 20. 80, that bid-ask spread is too wide for us. Like, that's not acceptable for us. And this is $3 wide. Like, we don't want it to be more than $1.60, like 10% max. So the bid-ask spread is too wide on the weeklies. So do we just move on to the next strategy? Well, we could, or we could look at, this is trading at 684. So could we come to January and maybe do a long call vertical and buy a vertical instead? So if we do the 680 and the 690, we're risking 490. How much could we lose? Well, we could lose all of it. But if we're saying, okay, that's a risk we can afford to take, and how high does it have to go? Well, it has to go up to 690. So if I activate, well, you can just, actually, it's easier if you just edit it. And so if we did a long call vertical at 680 and 690, 680, 690, and it expires January 16th. Does it look like that's in the path of where this stock might go? And if your answer to that is yes, I mean, it only has to move up by $5. And in an average day, the range on this stock over the last 14 days has been close to $35. So, could we get in and out perhaps, well before we get to January 16th? And that's a possibility. We saw that happen on one of our long call vertical trades last week on Albemarle. And we'll look at that in a few minutes. So our goal, if you look at our example trading plan on these, whoops, we want to go to the trade tab, is a gain of 50%. So we're going to right click here, say, hey, when this gets to about $6, 405 times 1.5. So when we get to 6, and this may go in 5-cent increments. So let's make it 605. When it gets to 605, okay, 420. We're live in the market, so things are going to keep changing. So we'll go to 630. When we get to 630, we're out. And good till canceled. And and you might say, well, we're leaving a bunch of money on the table. Yes, we are. Are we okay with that? Yes, we are. Because we're saying if we can make a 50% return in, under 30 days or thereabouts, are we going to be okay with that? We are. Okay. Oh, Jerry was definitely in Houston. Yeah, does my ask look big in this? Yeah. We were joking about if you say bid-ask spread and a non-trader hears it, it might come across sounding a little different. Okay, so the next one we're going to look at, so there's our first trade. It turned out we were looking at doing a short put vertical, and I get asked often like, well, why do you pick one strategy versus another? In this case, it was our risk management that helped us decide which type of trade we were going to place. So here's Next Power. And when we come and look at Next Power at the chart, up 134% year to date. If your account was up 134%, would you be a happy camper? Yeah, I know. I'd be doing the happy dance. So, and of late, it's come up, pulled back, and it's been kind of catching its breath or going sideways. So could we look at this and say, hey, could we sell like a short put vertical here, maybe, like the 85 and the 80? Well, let's see, maybe they have single dollar strikes. Well, it only offers monthlies. So then it's like, okay, well, if I come down here, how much volume do I have on these? Well, thousands of contracts, hundreds to thousands. Like, look at this at the 65, you got 10,000 contracts. So that's pretty high. And then do we have a tight enough bid-ask spread, 30 cents? Well, that looks pretty good. So if we're bullish and we do this 85 and 80, the next question is, can we get enough juice for it to be worth the squeeze? So we're getting a credit of $1.95. Well, like, what does that mean to us? Well, how much are we risking? Well, we're risking $5 minus $1.95. So we're risking $3.05 to make $1.95. And our rule of thumb, so we're dividing that by 305, is if we're in this trade for 32 days, we want at least a 32% potential return on our risk. And we've got a potential return on risk of about 64%. And so we're saying, okay, well, that meets our criteria. How many of these are we going to do? Well, we're risking 300. Are we cool with risking 6? We are not. So we're only going to do one contract, right? Right. How did we make that decision? Position sizing. And the fact that we don't break that rule to that degree. So we're going to, and our example trading plan says when we've got 80% of our max gain, so if I round this up to $2, this is worth about 40 cents, you know, just kind of doing the math in your head. Let's see, $1.95 times 0.2, that would be 39 cents. So if we said, okay, 39 cents, if you want to get really particular, we're going to buy it back. Now, you know, if we meet next Monday and we've already got 50% or 60% of our max gain, might we decide to exit if we're seeing like a hanging man or a candle that indicates that uptrend may be waning? Absolutely. This isn't set in stone. We can always, you know, change our mind and get back out. So we're going to put that in our short put vertical bucket. And I say this one is kind of sort of bullish in that we're bullish on the stock, but if it continues to go sideways, we're still going to be fine. We have $1.77 worth of wiggle room. As long as it stays above 85, we should have a profitable trade. You know, as long as volatility doesn't do something extraordinary. Okay, so that's our second example trade. And now, shall we go to the dark side? Okay. So let's come and look at Oracle. And it's not that I am an Oracle. I am definitely not. But, you know, when we look at Oracle, I mean, you know, this is up 11% year to date. So it isn't beating any of the major indices, right? Like, and it came up here, hit 345 and is now trading at 185. So like it and Humpty Dumpty, you know, are kind of bonding these days. It's down 46% since that high that it reached in September. And, you know, there are some who may have been a little bullish saying, hey, we had this diagonal resistance breakout, but it is now moving to the downside. And so if we look at this and we say, hey, you know, there is an opportunity here that's bearish to say, hey, in an average day, this stock moves about $11.43. Or, well, now it's saying 11.78. When I first looked at it this morning, it was 11.58. And so we're just going to go with that because that's what I did my math based on. So this 1 ATR strategy is saying, hey, if this stock moves, you know, about the amount that it has moved over the last 14 days, and let's add like a 10% to the downside for this. So if this moves down 1 ATR, which is the amount the stock has moved on average over the last 14 days, if it moves down by $11.58, let's buy a put and let's put our target. And so if I change this to a scratch pad, and so this is going to be our 1 ATR bearish example. And it's Oracle. And the 1 ATR we're going to go with, just to make the math easy for me, 11.58. And so our target is going to be today's low, which is 184.27. Yep, 184.27 minus 11.58. And that is 172.69. I did the math ahead. And then our exit. So if things do not go according to plan, and in spite of our best technical analysis efforts, sometimes they don't, we hover over this candle, the high for today, 180, 188.97. So we're going to take that 188.97 and we're going to add 11.58. And if it goes $11.58 above that, then we are going to say, oops, this did not go according to plan. And this is a strategy where our expectation is that we'll be out in like 1 to 5 trading days on average. So our target here is going to be 172.69. Okay, so that's our target on that. Okay. And then our exit is going to be up here at $200.55. And the way we manage these is that at the end of the trading day tomorrow, if it hasn't gone down and hit our target, because this is a stock that's over $100, we're going to take and move the stock up to $1 above the close of tomorrow. So if we're wrong, we want to get out quickly. That is kind of the thought on that. Okay. Okay. So we're coming to our trade tab for Oracle. We're going to come out to January, and you may be saying like, hello, if we want to be out in like 4 to 10 days, why are we going out so far? It's just going to cost us more. And you're right, it is, but time decay is going to be less of an issue. So if we come and we look at the theta, which is the amount it drops every day just for existing, and we don't want to risk much more than 500 and we could lose it all. So we're going to do this 175 strike where we're risking 510 to 530. Our theta on that is 13 cents. So if we come out to December 26th and we look at that was it 175? The 175 strike, our theta is 7 cents a day higher. And it's 20 cents on a $2 option. Like that's 10% a day you're losing just on theta. And so by giving ourselves more time, there's less, hacking away at our profit by theta. It's happening at a lower rate. And so and then our expectation is we've got more extrinsic value that will sell when we sell. So we are going to buy. Oh, and I wonder if I can put this in. I tend to have issues on occasion. It's come up. Okay. I'm going to just shut that back down. Okay, so we're going to come to single order, first trigger sequence, right click, create an opposite order, and we're going to make it a market order that's good till canceled. And then we're going to put in both our target and our exit because it's based on the price of the stock. So our target is if it goes at or below 172.69, or if it goes at or above $200.55. $200.55. Save, confirm and send. Oh, I made a little boo-boo. That being the pesky human being, right? We can make mistakes. So we want to buy a put because we're bearish on Oracle for $5.30. How much could we lose? $530. Is that within our guidelines? It is. We want to sell that put when Oracle either goes below 172.69, check, or above $200.55. So we're going to put that in our long put bucket. And this is a 1 ATR target and exit. And these are managed daily. Okay. And so if it really dropped tomorrow and it got down to like within a dollar of our exit, of our target, might we choose to exit? Absolutely. So this is something that you are going to look at on the daily. Okay, so last Monday we did 3 trades on Albemarle. and 2 of them have hit their targets. The third one, let me just bring up Albemarle. So Albemarle, we did a trade with a Fibonacci target, and that target's 147. We also on this day put in a trade with a swing target, and that target was, let me just look at my notes. It was 132.50. And then the third thing we did was a long call vertical. And so if we come to our monitor tab, and then we were going to compare and contrast the three trades. So you can see here, last Monday we did a long call vertical. We paid $2.15. We got out for 330. Okay. So, and sometimes, this is paper money. So sometimes in paper money, it's possible that it could hit a target at a different time frame, a little faster maybe than it might in a live account. Oops, just let me get my drawing tool. So with this one for our long call vertical, we got in for 330, out for 215. Or sorry, we got in for 215, out for 330. So we made $115 a contract, or $1.15 a share. And how much were we risking? We were risking $2.15 a share, or $215 a contract. And so our return on our risk on this was about 53%. And we were in this for, 3 days. Okay. And we made in total $230 less commissions. I'm just not going to take the time to go through the commissions, but it was 65 cents per leg per contract. So, $2.60 to get in and $2.60 to get out. So you would have had to take about $5 off that. So we call that a base hit, and we would have been happy with that. And then on the stock, we bought 100 shares at 120, or 20 shares at 125.41. And we ended up hitting our target on that on Wednesday. Actually, the long call vertical, we hit our target on Thursday. And so with this stock, we got in for 125.41. We got out for 132.58. And there are no transaction fees on the stock. But so for that one, we made $7.09 a share. Was this? Oh, 132.58. So I got my math a little wrong there. 132.58 minus 125.41, 717, and times 20 shares. $143. So we made a little bit less, and we tied up more resources. But so does this mean we shouldn't trade stock? Well, no. One, some people aren't familiar with long call verticals, and they may not want to take that risk. And the reality is, if the stock didn't move at the end, this would have expired January 16th. January 16th, this could have expired worthless. Our stock would have still had value. So there are things that we have to take into account. Our return on our investment on this, because we were investing $125 a share, was about 5%, 5.6%. And so, we have one trade left in this trilogy or triptych of stocks, of trades that we were doing, and we'll just have to see how that plays out. We knew that the fib target would take longer to achieve. Sorry, I'm going to have a little drink here. Okay, so that's our review of two of the trades that hit their targets. Now, and a one trade that we are still in. So that's those three done. Okay, now with buy rights, we have two buy rights on the books. So let's come to our activities here. And with our buy right covered calls, we have one on GFS, and then we have one on Intel. And this one on Intel, we're up about $230 plus. I went out and did the math, and we also are up an additional $165 on this stock. We sold the first covered call at $37. The second covered call we sold at $40. And the third covered call, which is this one, we sold at $44. So we have exceeded our expectations on this one. And this expires Friday. I'll be in Miami, and Connie will be filling in for me again on Friday. But we've got 90% of our max gain on this, and it does expire Friday. So if we look at INTC on the charts, we can see that this has pulled back, but could it rebound and could we end up called out? Well, we could, and if we did get called out, would we be okay with that? Well, yeah, we were willing to sell it for 37. So being willing to sell it for 44, I mean, we're totally cool with that. But if we buy this back and then it's come down to this support level and it rebounds, could we sell the 44 again for January, maybe next Monday? And that's kind of a thought process that a trader might be going through. So we are going to come out and we are going to create a closing order and buy this back so that if it does rebound, we don't end up called out or having to pay more to buy it back. And then we have the opportunity to sell another one. So that's our thought process on that. Now, could we just roll it out now? That might be a question some of you are thinking. And I like the way you're thinking, but the idea is buy it back here when it's low, wait for the bounce, and it may not bounce, but if it does bounce and comes back up, we would receive a higher premium if we sell it when it's closer to resistance than if we're selling it at support. So that's why we're just going to close this out. And then with GFS, we're down to 15 cents. And if we said, well, if we're happy with 80% of our max gain, have we got 80% of our max gain? Well, yeah, a little bit more than 80%. And this too expires on Friday. And again, with GFS, is this the first one we've sold? No. But we've sold the 40 several times. And on on GFS, GFC rather. No, it's GFS. I just wrote it down wrong here. We are up another $147 on the things that we have sold, on the covered calls that we have sold where we have exited. So on this one also, and this one is coming down to a support level, the expectation is old resistance might act as new support. Now it might not, so we might end up just closing this out. But for now, we've had 3 down days in a row. Now, if we were meeting again tomorrow, might we wait till tomorrow? We might, but this expires Friday. And so we are just going to buy this back. We've got 80% of our max gain. Okay, so again, we're going to right click, create a closing order. And we're going to, well, let's see if we can get it for 15 cents. Maybe 17. Let's give it a shot. So we've sent that one in. Now we have, in our long call vertical, we have one here that says Triple M has an ITM. What does that mean? Well, it means that it's expiring Friday and that at least one strike is in the money. And in this case, only one strike is in the money. So when you're doing a long call vertical, it's saying, hey, I'd be willing to buy this at 165. sell it at 170. And because we're in between, now when I first looked at this, we were only down about $25. But because this expires Friday and it's in between the strikes and it's falling today, like this was a profitable trade on Friday. It's just gone, south on us today. But let's look at the chart. So because here are our strikes and this is a big candle, this is a bearish engulfing candle, and support actually for this isn't at this 165, our next strike. It's kind of down here at around 163. So we could lose $290, and so far we're down 87. So we're going to, take our loss on this one and say, dang it, if we had a little more time, we might be able to exercise a little more patience, but we don't. So we had our expectation was to get out at 435. We're going to say, you know what, looks like 202 is going to have to do. So we're going to exit that long call vertical. Okay. So that is that one. We reviewed that one. Okay. And then I want to review also, we have one short call vertical on CMG, Chipotle. And so with Chipotle, I mean, here's a stock that is bucking the trend, right? It's down 40% year to date. And on this day here, we said, you know what? It looks like this 32 level is acting as a support level. And then what happened is 2 days later, it broke out, came back, looked like it was coming to retest. Now this 30-day moving average looks like it's coming in as support. This is not good for us. And this too expires on Friday, and it's through both strikes. We had a strike at 30. Well, let's look at this. Our short call vertical, our strike at 32.50 and 35, and it's through both strikes. So you think, well, obviously we're at max loss, but actually we're still $20 away from max loss. But one of the challenges could be if this comes back down a little, we also don't want to end up in between the strikes, because it's likely to be, if it's in between, it would mean, this 35 call, so, that's just, and it would in high likelihood be automatically exercised. And that's not what we want to see. So we're avoiding $40 of max loss if we're able to get filled on this, but we're going to admit that this one did not go according to plan. We had hoped to buy it back for 13 cents. That obviously did not work out. So 229, let's go 230. And we're better to admit quickly when we're wrong. And I'm not saying we're admitting quickly, but this is 4 days to expiration on a short vertical. So, we want to make sure that we're managing things, right? So that is CMG. Okay. So there were several other trades that we ended up getting out of. One was STX. And on STX, we did a swing trade with stock. So we bought the stock on December 10th. So let me go to STX. Maybe that's when we sold it. Yeah, we bought it on the 8th. So we bought it last Monday at 284. We sold it for 297. And this idea was like, we're just in for a little win. We're going for a base hit, and I call it, this group sometimes, Barb's base hit brigade. We just want to be small, nimble, and quick and get in and get out. And so on this one, we had how many shares? 17 shares. There actually are no transaction fees. We ended up making $12.87 a share at times 17 shares. So $218.79. You may say, well, that's not a ton. But, remember, we started with $25,000 at the beginning of the year, and we're close to 34,000. We're at 33.8. We were just over 40,000 this morning. So the market's kind of chipped away a little bit, but that's, over the course of the year, and the year isn't done yet. So it could do some adding to the profit or some taking away, and it is paper money, but we're up about 40%, so that's not too shabby, especially, given that I've probably missed 20 to 25% of the classes this year. We meet Mondays and Fridays for 45 minutes. And with my travel schedule, we often have people filling in and they're using a different account. And so, but, when we are trading, our example trades, we're trying to trade them with discipline. We have a paper, an example trading plan. And if you're saying like this example trading plan, of which you speak, where do we find that? Well, we're going to come to Trader Talks from Schwab Coaching. And if you, have not subscribed, if you're new and you haven't subscribed to the Trader Talks from Schwab Coaching channel, you'll want to do that. And then if you come up here, to playlists and scroll down to the trade management mini sessions one, and you'll see tomorrow I'll be adding number 11 in the short candlestick pattern series. So if you want to do some bite-sized binge technical analysis eating, what is a hammer, a hanging man, and so on. I've got probably 6 more to add to that series. But then if you come down here, here's an example trading plan for a long call vertical, which is one thing we did today. Here's a long call with a 1 ATR, an example trading plan. So you could flip that and reverse it to do a long put. And then a short put vertical example trading plan. So you can watch these and then create your own template, something that will work for you. And a lot of the things that I've talked about today, are in those example trading plans. Okay. All righty. So just let me come back. I just want to be able to look at the chat. So there's that. Now, that was STX. We also, did an example trade on UPS. And we placed that when we were in that one a lot more than the 2 days we were in the STX trade. This one we bought on November 7th, and it hit our target on December 10th, $99.22. So we made just over $4 a share on that one, times $50, so just over $200, a realized gain on UPS. And when we look at UPS, again, this was a swing target. And on December 10th, it hit that target. And so, we were just looking for little wins. And then on Micron, we did a long call vertical. And we got out of that one, I believe, on the 10th as well. So if you're just wondering, what happened to some of these. So we got in on November 14th for 240, out for 375. So, about that, 50% return on Micron, and Roku the same. So guys, that's a wrap for today. I hope that you found this interesting and informative. I love getting to, kind of trade ideas with you, and place these example trades, manage this account. I will be with you next Monday, the Monday before Christmas. Connie will be with you Friday. If you're going to be in Miami this week, I'd love to meet you. Please come up and introduce yourself. It's not too late to join us. So if you live in the Miami area, come. You can register on site. You can still register online. We are meeting Friday and Saturday. It's Intro to Technical Analysis and Introduction to Option Trading. The fabulous Mr. Ben Watson will be there, along with Rachel and myself and the travel team, who are all fantastic. So if you haven't hit the like button, please do that. It helps move this up in the trading algorithms on YouTube, so that more people can find this content. Subscribe to the channel, follow us on X, and have a really awesome day. I'll see you tomorrow for Getting Started with Technical Analysis. Stay tuned. James Boyd coming up next.